Hello, everybody. Monday night, so this must mean we're doing something special. So nice to see everyone in the live chat. My name is Downtown Josh Brown. I'm here with my co-host, Michael Batnick. As always, Michael, say hello.
Hello, everybody.
And guys, we are here for a special edition of Live from the Compound with an extremely special guest. I'm so excited to get to chat with him. He reminded me backstage that we haven't been on air together since probably before the pandemic. He is, in my opinion, one of the brightest market minds, one of the great market historians who's got insights spanning really decades. And this is going to be a lot of fun. Before we go to our special guest, Michael wants to tell you about our sponsor.
And before we do that, I would be remiss if I didn't mention, great quarter, guys. We did it. We just wrapped up the third quarter. The S&P 500, an all-time closing high. Not so bad. I thought there was seasonal weakness in September, Josh. What happened?
Yeah, not this year.
Not this year. Okay. All right. Our sponsor for today is Public. They've got this really neat, cool new feature where you can select a basket of bonds from individual companies. You could choose your maturity, and the Fed is going to be lowering rates for the foreseeable future.
They got a fast start. They got a fast start too.
They sure did. So who knows how long these deals are going to be around for, but it's super neat and really interesting and easy and intuitive. Click, click, clickety clack. Get some bonds, Apple, Google, whoever you want, in your name at Public.
You guys, you can go to public.com/compound to learn all about the risks, the rewards, how this works. I urge you to do so. All right, let's bring in Sam. Hey guys, everyone say hello to Sam Stovall. Sam, so great to have you here. I'm going to read your bio in a moment. Let me just make sure you're all good. You can hear us?
I certainly can. I'm happy to be here, Josh.
All right, terrific. So, as mentioned, the eminent Sam Stovall is the chief market strategist at CFRA, an independent equity research firm that acquired S&P's equity research department in 2016. Prior to the acquisition, Sam was the chief equity strategist for S&P Capital IQ. He's also the author of The 7 Rules of Wall Street and 2 other investment books, and currently writes weekly commentary for CFRA's advisor platform. Sam, so great to have you tonight, especially momentous. We just ended the third quarter, and I know you have some commentary on where we stand, so everyone's really excited to hear it. Thank you again.
No, my pleasure. Let's go.
All right, let's get right into it. You sent us a really cool table, and let's start right here. So I'm going to have you walk us through this in a moment, but I think one of the things that you've been doing for a long time, and you do it better than most, is giving investors the context that they need in order to not just make good decisions, but also avoid making poor decisions. Why don't you walk us through what we're looking at here and why it's relevant to you right now?
Well, what I like to do is I use history as a guide. I say it's never gospel, but it certainly can offer investors a good idea as to what is likely to happen going forward. I'll go do a little bit of history and to say when we started 2023 after declining almost 20% in 2022, because we had an up January and we also had the first quarter low that did not undercut the prior December low, it basically said every time that has happened since World War II, the market was up by about 25% and rose in price 100% of the time. 2023, we were up more than 25% on a total return basis. Heading into 2024, then the question was, okay, it's an election year. January was a positive performance. Every time since World War II that we've had a positive January in an election year, the market was up close to 16%, rising 100% of the time. But it doesn't mean you cannot have volatility. What this table shows is that in the first quarter of this year, we posted the 11th strongest first quarter return since World War II. But
wow.
Since it's sort of like that old Milwaukee beer tagline, it just doesn't get any better than this.
And that's how it felt. Yeah.
Oh, exactly. So my question was, okay, well, we probably are going to have a couple of pullbacks, declines of 5% or more, maybe even corrections. And interestingly enough, 14 of the top 15 indeed had those declines of 5% or more. And whenever those declines were less than 10%, essentially all of them had a second decline in the same calendar year. So I had written that investors, in a sense, should be aware of, but don't let your emotions become your portfolio's worst enemy, because they'll probably end up being pretty nice buying opportunities.
We got two this year. We did get 2 of 5% decline. So good call.
Thank you. Thank you.
What were the two? What were the two? You call them, hey, Sam, you call them intra-year trend interruptions. So I noticed that you're not using corrections. Is there a specific reason or not really?
Yes, I'm not sure I was smart enough to use the phrase you just came up with, but I tried to break the declines into noise, which is 0 to 5%, pullbacks, which are 5 to 10%, corrections 10 to 20%, and then bear markets 20% plus, some being garden variety, some being mega meltdowns. Why? Well, that's because people are departmentalizing. They like to compartmentalize things, mainly because when you deal with like a pullback, 5 to 10% decline, we've had 63 of them since World War II. The amazing thing is it's taken only a month and a half to get back to break even. And even with the near 25 corrections that we have had, it's taken only 4 months to get back to break even. So I tell people, look, by the time you've worked yourself up into a frenzy to say, oh my God, I want to lighten up on my exposure, call your advisor, harass them. And when they finally say, okay, I'll do it if you stop calling, by then the market is probably already on its way back to break even.
Sam, I bet in recent years, if you look at the data, the recoveries are even quicker than they had been historically. Would you say that's probably accurate?
Yes, typically with the fact that more computerized trading has been taking place, that these recoveries have been quicker. And if you look to the NASDAQ itself, while those sell-offs are sharper and quicker, so too are their bounce backs.
You pointed out that when you get off to this strong of a start, including Q1 and Q2, it's 14 out of 15 years historically, you end up with a double-digit full-year price increase, and the average is 23%. Before you mentioned the 100% win rate. 100% win rates definitely get my attention for obvious reasons, because it doesn't mean that the next time you won't go from red to black, but for me, when you can collect and amass probabilities so far weighed to one side versus the other, even with a somewhat limited sample, to me, it speaks to human behavior. Do you have an explanation for why markets that start off with a blistering first and second quarter typically follow through as you get to December? I'm guessing it's behavioral, but maybe it's not. What do you think?
I think a lot of what happens is behavioral. Well, maybe the fact that the first quarter return was so strong was more of an indication by the smart money that we really don't have a recession to be fearing anytime soon, that the Fed will likely to be cutting interest rates. And traditionally, at least what I say is wanting is more profitable than having, meaning that the market has gained about 18% in the period between the last rate hike and the first rate cut, but only sub 5% 6 months after that. Right. So if we can make some money, make some hay between the beginning of the year and when the Fed finally does cut rates, then that's really good. And then FOMO starts to kick in. So traditionally, investors are buying in because they don't want to miss out.
So we have a bunch of prepared questions for you, and I just want to remind the live viewers, if you guys want to ask some questions of Sam, this would be a great time to start submitting those. We're going to comb through, and if we have time, we'll get to some of the really good questions that you guys have. And if we don't have time, Michael will come on What Are Your Thoughts tomorrow, and he'll just answer them for you. All right, so the first thing I want to ask you, Sam, just to set the stage, is can you tell us about your time on the Investment Policy Committee and what the committee does, and what exactly is CFRA in distinction to S&P Global, which I think more people are familiar with?
Sure. Well, first off, S&P Global, because it's an older firm, there really was a guy named Henry Varnum Poor who wrote these. They were merged with the Standard Statistics Company in 1941. Jokingly, I say they were going to call themselves Poor Standards, but then decided to go with Standard and Poor's.
Okay.
But I think S&P wanted to get out of the fairly narrow margin business that equity research has offered, and they sold it to CFRA, which originally stood for the Center for Financial Research and Analysis. Well, Peter DeBoer, who is the CEO and the founder, he basically says, I want to put together a whole host of independent research available to investors. So the forensic accounting, which was started by Howard Shillett in the 1960s, is part of the organization. We have the wealth management research, which is the old S&P. We picked up Lowry Research, which is a technical analysis firm. And then we also added Washington Analysis, so a lot of political strategy. So a full gamut that people can learn about by going to CFRAresearch.com.
Okay, great.
Sam, I want to ask you about categorizing and classifying stocks in today's economy, which bears very little resemblance to companies of yesteryear. So, for example, Apple, they make TV shows now, and they also sell watches and AirPods. Amazon does delivery, and they've got the cloud. Google is developing AI, of course, and they're also doing taxi rides. If I look at home builders, they're not in real estate because they're not REITs, they're industrials. Airlines are industrials, but cruises are discretionary. It seems like the classification is just very complicated. Talk to us about how the committee thinks about these things.
Well, first off, we don't establish the different sectors, industries, and indices themselves. That is the S&P index that does that. But I do know that, let's say you take a company like Walmart and you say, well, shouldn't that be in retail? Well, the answer is no. It's actually in consumer staples retail, not primarily because more than 50% of the revenues come from food. So yeah, it is when you have conglomerates that are involved in many different activities. Amazon is in consumer discretionary, yet Google is in communication services. Apple is in technology. Really, it's sort of a best guess as to where most of the revenues and therefore most of its impact will be felt. So we do have more than 100 analysts who are following stocks in the large, mid, and small cap arenas, as well as overseas. They are given different sector assignments. So a lot of times it can be tricky. So we either look at intrinsic value calculations, discounted cash flow, but also sum of the parts to be able to figure out, what should be the appropriate price targets for these firms.
So I think the index committee got one right when Uber became one of the largest publicly traded transports. I'm sure there was a temptation to just throw that into tech or consumer discretionary because really it could be both. But it's nice to see finally there be like a high margin, high growth business in the transport index and not everything in there be an old cyclical. So I like when that happens in the markets. I'm not sure where they put Airbnb. Hopefully it's with the other hotel chains. I don't know. It might not be. But I guess the purpose of the question is really maybe just to reinforce to people, we have all this research on what sector, what industry, what's leading, what's lagging, which industries are most levered to Chinese stimulus or the Fed. That seems to be getting harder as the years go on, not easier. And maybe that's why you really need sector experts like yourself to kind of elucidate you into like what's really happening below the surface.
Well, you're absolutely right, because with companies being so intertwined with different areas, like Uber is in the passenger transportation group. Now, transportation used to be its own sector, but now it's part of industrials. Interesting,
Right.
but transportation was one of the earlier moving groups within an economic cycle, and industrials being among the latter. So together they end up sort of smoothing each other out. The problem is that when you look to the different sectors, you have a small number that are actually really dominant, with technology being above 30%, communication services, consumer discretionary above 10%. But what about utilities? What about energy? What about materials? All of which are below 5%, even around 3%. So you sort of wonder after a while, how long will they be their own sector? So I think that's why people are moving beyond looking just at sectors, but looking at the industries that the companies are found in, and also overlaying the momentum and technicals to decide which companies move more in tandem than the others.
Sam, Josh had a take so good maybe a decade ago. It was so good that I think he stole it from somebody else. There's no way that he's clever enough to come up with it, which is that semiconductors are the new transports because of the way that they transport digital information, which is the backbone of this new economy.
No, I made that up.
Did you?
I swear.
You sure?
I don't lie about stuff like that. Yeah.
Sam, what do you think about that distinction or that classification from Josh?
Well, I think that's good. Certainly from a deeper dive. Dave Keller, who until recently was doing the final bar on stockcharts.com, and he has his own program now on the web. He basically said that the old Dow theory really should be changed to the Dow plus the NASDAQ instead of the Dow Industrials plus the transports. Basically, as you're saying, that we don't have a Star Trek transporter just yet, but in a sense, semiconductors are doing that, or technology itself is doing that for us.
I mean, Dow theory's from what? Is it from the early 1900s?
Absolutely, 1896.
Like I know that's when the 1896 is the date that they launched, but like that theory is it's ancient.
It is, but it certainly makes sense in that, yes, you want to see whether the industrials are doing well, but at the same time, it's like the old corrugated box index. You take a look at whether more and more boxes are being ordered. If that's the case, there's the anticipation of an increased fulfillment of those orders and so forth. So it's really more of a confirmation of what people are anticipating.
Sam, I want to pivot and talk about ETFs, which I think unarguably is the investing megatrend of the last 25 years. And this week, ETFs just broke above $10 trillion in assets under management for the first time ever. And that's 10 trillion US only. So this does not account for the growing popularity of ETFs around the world. This chart comes from a piece by Isabel Lee at Bloomberg. She writes that the asset class has been doubling every 5 years. The last double only took 3.5 years. So we went from 5 to 10 just since the pandemic. And she says assets held by ETFs in the U.S. hit 10 trillion for the first time. A combination of inflows and market gains carried total assets over the milestone this week. Investors have poured $691 billion into the funds this year as U.S. stock gauges have notched repeated records. So it's not just that the S&P is rising and taking that ETF AUM with it. You had another $700 billion in the first 8 months of this year already coming into these funds. First of all, what is the impact of that much money in this wrapper? And we know how concentrated the money is within ETFs. Are index funds distorting the market at this point, or do you think that there is a level at which they might?
Well, that's a pretty compound question. I actually reached out to Aniket Ulal, who is our ETF expert at CFRA, and saying, when you look at the flows of ETFs, the growth that we've been seeing over the last several years, is that really just new money? And the answer is no, because if you look at each of the last 5 years of the long-term mutual funds, meaning equity funds, bond funds, et cetera, they have been in a very large net outflow environment. Yeah. The money is going into money markets that then end up going into ETFs. I think several reasons for that. First off is, you have the ability to decide when to take capital gains. You don't end up with a negative year and then have a very hefty tax bill as a way to say thank you for that.
That's the worst.
It is. So you decide on capital gains. Also, because of a like-kind transfer, you can have a switch, let's say a seasonal rotation, like mine, SZNE, the seasonal rotation ETF. But because it's a like-kind, there's no tax consequence. Also, you have more in institutional activities. You have hedge funds that invest in ETFs rather than investing into mutual funds. And also because you have more of the factor-based ETFs, something that goes beyond your vanilla index ETFs or mutual funds. So I think there are a variety of reasons why ETFs are exploding in terms of assets under management. And, indexes are just part of it.
Is it too big though? Like, do you worry that it's too many people allocating in the exact same way with too many dollars, or does the market sort itself out regardless of the wrapper?
Well, I think you're bringing up the point where, let's say, things do turn around and we do end up taking profits, et cetera. Does it end up being a very accelerated downward decline because so many people think they're diversified when in fact, really, they're just overlaying the same stocks from different ETFs? Well, I think that's where an educated investor or a financial advisor would assist the client by saying, look, you think you're diversified, but you're really just coming up with multiple ways of adding the Mag 7. So
Yeah.
I think that has been a consistent problem ever since the S&P 500 index mutual fund was created in the mid 70s.
I want to ask you an add-on to that. That's a little bit like a question about capitalism itself. A few years back, there was a lot of talk, mostly coming from firms that run actively managed portfolios on Wall Street, saying that the popularity of passive investing and indexing is kind of like a road toward communism or Marxism, or maybe both. Other than laughing, what's your reaction to that sort of commentary? Is that something that we need to be concerned with, that if so few people are willing to take risks away from the market or make active choices, we're going to end up with a market that no longer works, or worse, turns us into a communist country? What do you think when you hear stuff like that?
Well, my first thought is if it's being stated by active managers, it's probably a lot of sour grapes, because as spindices.com will tell you with their SPIVA, S&P index versus active report, that it's very hard to beat the indexes, primarily because, as John Maynard Keynes says, the market can remain irrational longer than one can remain solvent. So while an advisor would be probably trimming their holdings as valuations get higher and higher, the indexes just run with it, and so over the longer term they do tend to outperform the active managers. I think the real question would not really be with indexes, but what about AI? If AI is going to be running portfolios, then after a while the question is, if everybody is putting in the same parameters into the programs, then maybe we end up only seeing appreciation that equals earnings growth in and every year. So I sort of wonder what the effect will be for AI on investing and returns.
Oh, could AI be so logical that it eliminates the potential for anyone to earn excess return because it will perfectly calibrate share prices to earnings? Is that what you're saying?
Yeah, that's pretty much what I'm saying. Of course,
Okay.
every human has the ability of tweaking their own model to try to gain a front edge on others. But if AI is also self-learning, then maybe it learns from others as well. And after a while, it's simply based on the growth of earnings and interest rates.
Sam, why do you think it's become increasingly hard to beat the index? Is it a function of AI in terms of the AI trade, not the AI that you were referring to, in terms of data becoming more ubiquitous, the leveling of the playing field, the access to all of these sort of alternative pieces of data? Was it ever easy to beat the index? What's your take on all this?
Well, I think it's all of the above that you had mentioned in terms of more people being involved, more data being available. et cetera. But I also feel that a lot of it has to do with human behavior, that fear is a much better or greater motivator than greed. When you look to all bull markets since World War II, only 15% of the days had moves of 1% or more. Yet when you look at bear markets, the average is 45%. And so I like to say that my best bit of investment advice came from Clint Eastwood. When he played Dirty Harry in the movie Magnum Force, he kept mumbling through grit teeth, "A man's got to know his limitations." So basically, it's people are still, as long as humans are involved in the investment decision-making process, we will have volatility and we will definitely have underperformers and outperformers.
I thought you were going to say the Dirty Harry line. Do you feel lucky? So getting to what you said about the fact that bull markets see a lot less volatility. Bull markets are a grind. And if you're a bear, they can be exhausting because it's not like there's gigantic gain after gigantic gain like a bear market. It's a slow grind higher. And to that point, people would say, oh, an index fund is just a momentum strategy, as if that's somehow a bad thing. When you hear people say that, what's your take?
Well, you were fading in and out there. I'm sorry. So if you could summarize it quickly, take out every other word, then I can answer it.
Yeah, one of the derisive things that you hear about indexing is that the S&P 500 is just a momentum strategy. And they say just a momentum strategy, as though that were a bad thing. Does anyone want to be invested in negative momentum? So that it doesn't. It sounds like a compliment when people say it, but they don't mean it that way. Momentum is a very big part of the success of the S&P 500 as an investing strategy. You would agree with that, right?
Absolutely. I'm a big fan of James O'Shaughnessy's book from the early 1990s called What Works on Wall Street. And when it comes to momentum, he basically proved, and I did my own due diligence and basically reconfirmed what he had said, that you want to let your winners ride and cut your losers short. CFRA wealth management side, along with Lowry, did a similar study and basically said if you can merge the highest power rating relative strengths from Lowry with our stock appreciation ranking system, the frequency of outperformance does not go to 100, but certainly improves the index itself, and the advance itself is a couple of 100 basis points per year. So essentially adding momentum with fundamentals, basically, think about it. If a stock is an underperformer, it has an awful lot of overhead resistance. When it gets back to a level where somebody bought in, they're probably thinking, let me get rid of this dog and move on to something else. Right. So you have a long way to go before you can really start to shine. But with high momentum, how many people are going to brag about a stock that they have owned? How many people listening are not going to do their research and are going to buy into those stocks, which typically maintains that momentum for another year or so?
I wanted to ask you about one of the I don't know if it's a problem with indexes and sectors per se, but do you think at all about people front running stocks that are about to get added to the S&P 600, the 500, the mid cap? Is that robbing investors of gains that would have come had the news been a little bit more of a secret? Because Michael points out the inclusion criteria, for the most part, is public. And we saw this with some pretty well-known big names. We saw this with Tesla, notably. Everyone knew ultimately they would have to get added. Once they became profitable. Supermicro is another great example where you have a small cap with a gigantic market cap, and so of course it's going to get bumped up into the big leagues. How do you think about that? Is it something that maybe is a minor concern and not really worth worrying too much about?
Well, it's something that I do know that S&P index people have to take into consideration. I was never on the index committee. So I don't know specifically what they do, but yeah, they try not to allow people to guess who's going to be added or whatever. Took Microsoft years to be added to the S&P, mainly because of the ownership rules that more than 50% of the shares were owned by insiders. So until that had changed,
Oh, I didn't know
they
that.
were not added.
When was that?
Back in the early 1990s.
Okay.
And when also you have to look at companies that are profitable. So that's why you're not going to have 2,000 stocks like the Russell does within the S&P small cap 600. They have to be profitable. But the thought about, where do most of the gains come from when a stock is announced to be added to the 500? Well, they come from the stock that's in the 400. So that's why you own the 400 along with the 500, so you can benefit from those who get promoted to the large cap.
It's a really good point, actually.
Sam, on the flip side, I don't know if you saw this, but Research Affiliates is launching a product that is based on the premise that once stocks are removed from the index, and by definition, stocks get removed after a prolonged period of really lousy performance. Once a stock is booted out of the index, there's this phenomenon that it has, at least I would guess in the short term, it tends to outperform. Any thoughts on this and maybe capturing it as a profitable strategy?
Well, it's certainly something that's interesting. I'd like to see the back test on it, but
don't worry, it looks good.
I've heard it as well about the Dow, companies being kicked out of the Dow, companies being removed from the S&P 500. What could be the case is that now you have many fewer people who are actually following the stock, probably increases the inefficiency potential. So therefore one could, make some money based on that. But it is an interesting phenomena because you would think that, first off, the momentum has been down for a while, so that would be a negative. But as I was taught back at NYU in the 1980s about technical analysis, even dormant bottoms can reverse themselves after a while.
I want to go to the live questions being floated by the fans, and there are many people here watching us right now, and we really appreciate you guys. Dave Airy makes, this is more of a comment than a question, but I'd love your take on it. He says, I don't see how ETFs get into the 401k market given pricing during the day versus end of the day. So this is always a big debate. Like, is the best use case for mutual funds still 401k, given the way money has to come in and buy proportionally? It's a little bit harder to do that if everything's a moving target before 4 o'clock. Do you have a strong point of view about whether or not ETFs will finally colonize that final frontier?
I think it probably will because if people demand it, then sooner or later those demands get satisfied. Good point, though, about how the 401ks tend to be marked to market at the close. So that really wouldn't change too much. And it really wouldn't matter to do the intraday trading because it's all going to be taxed at an ordinary income basis. So, in terms of trying to time situations or whatever. So, I would tend to say that ETFs probably will be made available. I know they were when I was at S&P. You did have the ability to go into more of a brokerage kind of an environment. That was an option. But for the more pure vanilla kind of 401ks, they primarily stick with mutual funds and more so with indices because they also want to make sure that the unsophisticated investor employees do not then turn around and sue the company for putting them into highly speculative investments.
I guess what is the benefit of an ETF in a 401k if we're not going to take advantage of intraday liquidity, which God help us, let's hope that's not what's going to happen, or B, we're not going to take advantage of the better tax treatment because it's unnecessary. Is there a reason that we would prefer there to be ETFs versus their counterparts as like plain vanilla index mutual funds? Can you think of a good reason why somebody should be pushing for that?
Well, I think that there could be different strategies that are used in ETFs. More and more, we do end up having them be actively engaged. I mean, there used to be the pseudo active, like the dividend aristocrats or low volatility ETFs,
Gotcha.
et cetera.
Yeah.
And many of those are really not found in mutual funds. And so I think more of the creative portfolio structures are being enacted in ETFs today because their capital base is expanding, whereas the mutual funds are shrinking.
Someone asked an individual stock question. I know you can't answer it directly, but
I got it.
Uma Venkatesh asked, do you think NVIDIA will be added to the Dow replacing Intel? So without the specifics of NVIDIA and Intel, just broadly speaking, it's not the first time we've had a blue chip company that's really important in the indices. And in Intel's case, it was a big weight in the Dow, in the S&P, and in the NASDAQ. It was kind of a stalwart tech blue chip. And it is obviously not that anymore, just based on market cap, profitability, et cetera. How hard is that decision to make for the index providers? Like what do you think? What do you think are the things that have to be thought of before they just take the hottest stock in the world and throw it into the index? It's already the biggest or the second biggest market cap in the index for the S&P. Before you do something like that in the Dow, I feel like that's got to require a lot of internal debate. What do you think goes on?
Oh, I'm sure there is, but I think what the Dow as well as the S&P is really trying to do is to say, is this a good reflection of the U.S. economy? Is this a good representation of the exposure within these 11 sectors? So swapping NVIDIA for Intel probably could be something that would be easily justified. Also, the price of NVIDIA is only 10 times that of Intel. It's not like going into Berkshire Hathaway
Right.
because the Dow being a price-weighted index versus the cap-weighted index like the S&P. So, that is certainly a possibility, but it's all speculation on my part.
If NVIDIA were to come in, it would be a bottom third stock, probably making its inclusion more likely than less likely. Right? If it had a $900 share price, forget about it. No chance.
No, I would agree with that it would, less of a divisor impact. Also, rather than being the 800-pound gorilla within the Dow, but it's still a company that within the tech sector, but also within the semiconductor industry. So in many ways, it could end up being a fairly logical performer. I think some people would probably like it to take place because the Dow typically has about a 96% correlation with the S&P 500. But since the Mag 7, that correlation has been slipping. So I think the originators and the maintainers of the Dow probably would rather have it come back up to that kind of close approximation.
Sam, I want to say thank you so much for your time this evening. And I want to tell people where they can get your research or learn more about CFRA and the various products and services you guys offer. Where would be the best place for them to go?
Best place for them to go would be CFRAresearch.com. They can get a free trial to our MarketScope Advisor platform and our Lowry Research. And if you have an advisory service, like whether it's Schwab, whether it's Morgan Stanley, et cetera, a lot of CFRA research is available free on their website.
And you are active on social. I know you're LinkedIn, and are you tweeting?
Yes, I'm tweeting, but with some help from people who know better than I.
I understand. I understand. You probably don't want to wade into all the trending topics each day. All right. So everyone follow Sam on Twitter, on LinkedIn. Check out the CFRA's website. Sam, this has been so much fun for Michael and I. We're huge fans of your work over the years and decades. Thank you for all that you do. Let's not wait so long for the next time, okay?
I look forward to it. Thanks, Josh. Thanks, Michael.
All right. Thanks to everyone for joining us on the live. We appreciate it. We will see you tomorrow night right here for an all-new edition of What Are Your Thoughts? Have a great one.